So I'll just quickly come to the investment process that we have laid out, and it's a very process-driven approach. We believe long-term India will grow between 6.5-7% GDP. We were never big believers of 8% plus, given a lot of constraints in the way India functions. Current readings are sort of much lower than that. Our sense is it is cyclical, but when you're modeling numbers of companies, we believe long-term we'll get back to that 6.5% GDP growth. We believe inflation in India will be about 5 to 5.5%. Now, whenever the analyst is modeling a company, and we have a large team of analysts, so the auto demand, when he's forecasting, he's benchmarking it to 6.5% GDP growth. The cement analyst, when he's forecasting cement demand, is benchmarking it to 6.5% GDP growth. Everything else is bottom up. So everything else, he'll go and meet the company, the suppliers, vendors, and create a detailed research model with minimum 5-year history and 5-year forward forecast. And that is how he'll build a model. One of the big requirements that we have when we manage the money is the stock needs to be liquid. The reason for that is when we were managing money in the early 90s, when we were buying all these illiquid stocks, the stock price would go up, right? And we looked like heroes because the stock price was up and the NAV of the fund was high. But when we had to meet redemptions and when we had to sell out of these funds, there was no liquidity. And because of us selling, the stock price would just collapse. And we realized that the portfolio value was not a reflection of a true portfolio value. It was being influenced by our action. So hence we put in a liquidity filter. The stock needs to trade over $1 million a day for it to be considered for our investment universe. Currently about 450 companies meet that criteria. About 200 companies we strip off purely on corporate governance. There are a lot of companies where managements we don't trust. Their numbers are highly suspect and their corporate governance practices are highly suspect. These are not the companies we will invest in. We are happy to underperform because there comes phases where these companies do well. But it's a policy that we have right from day one that we will not invest in such companies. After that, about 250 companies remain, which is what our research team covers. Each of these companies will have a detailed 5-year model, history and forecast. And each of the companies, the analyst will sort of prepare his numbers and come to the entire research team. Now, we wanted to ensure there is no individual bias when he's forecasting numbers. So the entire 15 of us will sit, we will discuss his numbers, debate his numbers. And based on his 5-year forecast, we'll put a buy and sell limit for each company. Buy limit typically tends to be at a 40% discount to long-term intrinsic value, which could be at median multiples or 10%, 20% above that. A lot of the times, companies have never traded at that big a discount. So we narrow the band to ensure that there's a actual value where we can buy, not a theoretical value. Now, about 250 companies that we have in the research database right now, all of them will have a buy limit, all of them will have a sell limit. Only when the stock comes below the buy limit will the stock come to the portfolio. And only when it goes beyond the sell limit will it go out of the portfolio. There is no fund manager discretion where we sit and decide, let us add this stock to the portfolio now. It has to be approved by the research team and it has to come below the buy limit. Because of this, what happens is in periods when markets are rising very rapidly, a lot of sell limits are getting hit. And if we don't find alternate names, we have to sell out of them if we don't believe the earnings are going to go up. And that is the time cash gets built up in the fund. So we've had a history where we've had very high cash levels in the fund. It is purely because of this reason. We don't take and sit a call that markets are expensive, let's sell out of the company and raise cash. If the cash levels are high, that doesn't mean the markets will correct. We've had high cash levels, yet the market kept on rallying. It is just that we don't see value in the market at that point in time, nor do we see opportunities of companies below our buy limit at that point in time. So typically our portfolio tends to be at 25 to 40 stocks. Currently it's at the lower end of that number, about 25 stocks. Yeah. So in terms of the portfolio construction process, again, we are not index replicators. We don't look at the index when we are building the portfolio. Theoretically, we can be 100% in one sector if that is where value is. So hence our weights tend to be very, very different from the index. Some of the biggest names of the index, we don't own them. But all it has to be is it has to be below the buy limit. And based on criteria that I've laid out, if the quality of management is really high, the earnings quality is really high, we believe there is stability of earnings, it will have a very high weight. It could be 5 or 6% when we are buying into that company. If we believe on this box it scores low, very less, we might have a lower weight initially when we add it to the portfolio. So it is not necessarily the highest upside stock will have the highest weight. If we believe the earnings is a lot more volatile, we might restrict it to a lower weight. So this is how we typically build a portfolio. Again, so if we don't find value, we will stay away and we'll wait patiently for value to come. And that is the style. That is what you're meant to do in phases where you find markets euphoric. Again, cash levels might increase if we don't find value, and if we believe there's any kind of corporate governance event in the company, we will not touch it. This is sort of the track record of the fund. This is based on the process that I just laid out. Now, it looks very good in the long term, but investors need to understand this phase, right? This was 2006. We had just launched the fund, and that was the BRIC years. So Brazil, Russia, India, and China were the flavor of the world, and people thought these were the next big emerging economies. And everybody was coming to India to invest. And we had just launched the fund, and we could not find stocks that we wanted to buy. So our cash levels were high, and we were buying very boring companies, right? Companies which had very clean balance sheet, which were not taking undue risk. Nobody liked those companies then. People wanted companies which were growing at 30-40%, irrespective of the balance sheet quality. So I think in that 1 year, we underperformed by 20 percentage points. And our track record from 2006 to 2008 was actually terrible. And the same kind of questions that we are asked now in terms of what does the value style is underperforming, what is the point of value style if you're not able to deliver returns, was being asked then. But then the Lehman collapse happened, and then people suddenly realized all these funds who claim to be investing based on valuations were not investing based on valuations. So in markets, you can invest for two reasons. A, you think the company is cheap, you buy them, and eventually the market recognizes the value of those companies, and the company gets re-rated and you sell out of them. Or the second reason that you buy is you buy it even if it is expensive, and you believe there's a greater fool who will come and buy it at an even higher price from you. That was in 2006 to 2008. A lot of it was driven by greater fool. This phase perhaps might be very similar. We have to wait and see. But again, if we do not think there is value, we will not go ahead and invest in the markets or in the companies. And investors of value fund must expect these phases again and again. There will be every 4-5 years there comes a cycle where markets do crazy things which value investors don't understand. Their own stocks will not do well, and perhaps their cash levels might be high, and there could be 2-3 years of extreme pain. This is the sort of long-term track record. It's still outperforming because initial returns are much better, but this is last 3 years for us, which has been quite terrible. And again, a lot of people who've not been used to historical cycles in value to keep asking us why value, what is the point, it doesn't give great returns. But like I said, you have to remember Fund 2 versus Fund 1. And it's behaving like that Fund 2 right now. Hopefully, whenever sort of risk aversion comes back or people get more saner on valuations, the style will again come back. But it's not, this style is not meant for everyone. When you see the index giving that return and you see your fund not giving return, you will get restless and you will wonder, why have I invested in this fund? Let's come to the reasons why we are underperforming. Right? Why last 3 years are terrible for value funds, and last 1 year perhaps for most funds in general. Okay, this is the state of the economy, right? They rebased the series about 4-5 years ago, and even the new series is showing whatever. There's a sharp downtrend. Most companies that I interact with and most economists don't believe that number. They believe it's even lower. And now you have some economists putting out reports claiming why that number is not trustworthy. It's perhaps 1.5-2 percentage points lower than what the number that the government is reporting because of some data inconsistencies. But this has been the state of the economy in the last 5 years, right? And most of the other variables sort of match that. Most of the other variables are down. Now, this is the earnings estimates of companies in the BSE Sensex, right? This is the chart from 2014. So every year the sell side, which is a set of analysts who work on the broking side, they tend to have very high expectations, right? And as the year goes by, they keep on cutting their numbers every quarter, and they say H2 will be better. And last 4 years, actually, there's not been earnings growth. It's just been close to very low single-digit earnings CAGR. But this blue shaded line in the background is the market, right? So you had very little earnings growth, and the market is essentially just kept on going higher and higher. That is a period very dangerous for value investors. We don't understand what is happening in these kind of markets, right? This is sort of Bloomberg. So Bloomberg rebases it on calendar year. This is the earnings growth. So last 4 years, again, if you sort of accumulate it up, it could be like 3-4% CAGR earnings growth. There is high expectation over the next 2 calendar years, which again is doubtful. I don't think that is going to come, given whatever companies that I interact with. What are they? I think that number again will get cut quite drastically. The fact that you have had no earnings growth and markets are just going one way, this is what happens to the price earnings multiple of the company. This is the trailing multiple. but you are now at record peaks in terms of price to earnings multiple. It gets exaggerated because the banking sector, which is reporting a lot of NPAs, but even adjusted for that, it is a very expensive market right now. So it's not a market for value investor per se. So why is the market going up quite rapidly when the earnings are not going up and corporate companies are crying about the slowdown? So there was a big change in 2014. If you take the retail flows into Indian equities for 10 years before 2014, it was actually a net negative number, local mutual fund buying into the stock market. After 2014, once sort of Mr. Modi came into the government and it was announced that he's going to be the next prime minister, people believe there's going to be a transformation, and suddenly the flows change in equity mutual funds. Two other reasons was the state of the alternate asset classes. One is interest rates started coming down once crude collapsed, and second is this real estate, which is perhaps last sort of almost 7-8 years been either flat or negative, and people have a lot of money, and especially in the NCR market, which was a very speculative driven market, not that many people are looking to invest in real estate anymore for the last few years. So where do you invest in that environment? When you look at stock market going higher and higher and you think Mr. Modi is going to come and transform the economy, automatically a lot of money comes to the real estate, to the stock market. And then it's sort of, equity markets are like that. If the markets are going up, more money comes, it goes up even further. And as it goes up further, more money comes. And so it sort of fuels a bubble which gets created in the market. So you had this massive inflow of money coming in at a time when the economy was not doing that well. But given that it was going up, people did not bother. And it continues to go up. And sort of earnings profile is not looking that great. A lot of the money went into the small and mid cap space. Now, after the big correction that has happened there, nobody wants to look at that space. But again, this same cycle played out there. So I know in 2017 when I used to do investor sessions, and we don't have a small and mid cap scheme because of our belief that it over the long term it really doesn't sort of generate value. But the number one question that we used to be asked is, why don't you have a small and mid cap scheme? Look at the performance. It's such a great place to invest. Now nobody tells me that, but this is what happened essentially. One of the big reasons why markets are going up despite lack of earnings growth. The FIs have always loved India, so apart from sort of brief period during Lehman and afterwards, but this is the big delta which is sort of changed in the market. And I think the cumulative flows for the last 4 or 5 years is higher than sort of last 15 years put together. The kind of money that has come into the local mutual fund, which again fueled a big rally, especially in the small and mid cap space, which went up, and then there's been a sharp correction. The larger cap numbers the large caps have not corrected, and I'll come to you the reason, at least our sense of why it has not corrected so far. But it was a very speculative phase, and it continues to remain a fairly speculative phase in the market. Over the long term, large caps have actually done better, but in this phase, it looks like sort of at least when they were here and the large caps were here, all people wanted to do was just invest in small and mid cap funds. Now, given the collapse that they've seen, and again, I come back to Fund 1 versus Fund 2. A lot of the Fund 1s are seeing a lot of erosion in NAV value right now.